Now we're going to start Chapter 2, Part 1, and we're going to go over job order costing. And our particular focus in this part is going to be overhead. So let's look at the difference between job order versus process costing. Now, process costing is what we'll look at for the rest of the semester. And that has to do with we're making the same item. In essence, we're making the same item and we're going to mass produce it, like baseball caps. They're all identical and they go through a series of uniform production steps or processes. And what we do is we're going to use averages across all units produced. Now, job order costing is different because job order costing, it would be done by somebody who sells unique items, custom orders. They're relatively small batches. Now, a good example would be that somebody that does custom cars. Each unique product is a batch. And again, examples would be custom home builders, high-end jewelers, accounting, and law firms. What they do is they keep track of things by job. So, to each job, they add direct materials, direct labor, and overhead. And then it goes to work. It's in work in process. When it's finished, it goes to finished goods. And then when it's delivered, it goes to cost of goods sold. Now, the manufacturing flow is we always start with raw materials. That includes direct and indirect materials. We then transfer the costs as we issue them to work in process and to overhead if it's indirect. And then we're going to add labor and we're going to apply overhead. Then when they're done, we're going to put them in finished goods ready for sale. And then when we sell them, it's going to go to cost of goods sold. Now, in this process, we have three, and we're going to start in this particular part. We're going to cover just overhead. Now, overhead, the terms. We have what we call annual estimated overhead costs. This is an estimate. It's always done at the beginning of the year, along with an estimate of an activity base, or what we also call a cost driver. What makes the cost change? Then we also, based on that information, come up with what we call a predetermined overhead rate. And then, of course, we have the actual overhead costs that collect in the overhead account. And then we have the actual activity. And then at year end, we have the actual overhead costs and the actual overhead activity. Now, for the estimated overhead costs and activity base, these are used to estimate what we call the predetermined overhead rate to be applied at the beginning of the period. The predetermined overhead rate is applied throughout the year based on actual activity. Actual overhead costs, again, are collected in the overhead account. Actual activity is the basis for applying the predetermined overhead rate to work in process. At year end, we're going to use the actual overhead cost divided by the actual activity to come up with the actual rate. These two are never the same. The predetermined overhead rate, and because two things can vary, the costs and the activity. And that's how we come up with under or over applied overhead, which is the difference between the predetermined overhead rate and the applied. Okay, so let's take a look at an example. We have estimated annual overhead costs of 120, and we have three different cost drivers. We could either use machine hours, direct labor hours, or labor dollars. Now, you can only use one, okay? So now let's look at what actually happened during the month. So step one, we determine the overhead rate. We know what the estimated annual overhead costs are. We know this is the beginning of the year. We do a budget. And then we allocate, and again, it's always based on a cost driver. And in our case, we have a choice. We can either use estimated annual machine hours, estimated annual direct labor hours or estimated annual direct labor dollars. Step 3, we're going to calculate that rate. And it's always going to be the total estimated annual manufacturing overhead costs. Remember, this is an estimate. And we're going to divide by the estimated annual amount of the allocation base. Now, in our case, we have 3 options. We have to decide which we think is the best cost driver. Is it machine hours? Is it direct labor hours or direct labor dollars? Step 4, we actually allocate, and we take the predetermined overhead rate times the actual amount of the cost driver. So, if we applied it based on machine hours, we would apply to work in process $3,600 for overhead. If we applied based on direct labor hours, we would apply $5,400 to work in process for overhead. And if we use direct labor dollars, it would be $97. So as you can see, you get a different amount based on what you use as your cost driver. But your decision is which reflects the best way of allocating the costs. And again, you can only use one. So now, why is it important to come up with a good method of allocating, and I spelled allocating incorrectly, allocating overhead? So let's take a look at, we have this example. They decided to bid on a job that takes 1,975 machine hours or 1,600 direct labor hours to produce. The direct labor cost will be $12 per hour, and the direct materials will be $25.06. Your markup is 29%, and the estimated total overhead cost for the year is $369,260. Direct labor hours are 9,980, and annual machine hours are estimated at 18,463. So we're trying to compete on this bid, and our competitor has bid $125,500. So as you can imagine, depending on the cost driver we use is going to determine. So if we come up with machine hours, our predetermined overhead rate is going to be $20. If we use direct labor hours, we're going to use $37. So now let's take a look at what this looks like. We know that the direct labor and the materials is going to be the same, but it's that overhead rate that is going to determine whether we can come up with a bid that's less than our competitors. So if we use machine hours, we can do it. But I guess the question is that the best cost driver? And only the company can decide that. Now, what happens at the end of the year, or even during the year, and this is monitored, is we can end up with under or over applied overhead because, again, we start with an estimate. So it can either be under applied, which means that our rate is not allocating enough of the actual overhead costs, or over allocated, it's allocating too much of the overhead costs. All right, so we can be under applied or over applied. So what does that mean? Well, here's an example. If we end up with a debit balance in the factory overhead account, it means you're under applied because we didn't apply enough. If you end up with a credit, you're going to be over applied. Now, the journal entries are, if we are under applied, it's going to increase our cost of goods sold. And if we are over applied, it's going to decrease our cost of goods sold. Now, the truth of the matter is you want this to be close because nobody wants to find out later on that they made less or more money because of how we allocated the costs. So let's take a look at some examples. Ryan's Paint allocates overhead based on machine hours. We have estimated manufacturing overhead costs, and then we have our actual overhead costs. We have our estimated machine hours and our actual machine hours. What is the predetermined overhead rate? Well, we know we have to use the estimated manufacturing overhead costs divided by the estimated machine hours. So it was $11.75. How much was applied based on actual machine hours? We applied $264,000. Is it over or under applied? Well, our actual overhead was 244. We applied 264, so our overhead is over applied by 20,000. This means that cost of goods sold will be credited at the end of the period because overhead does not appear on the financial statements. We have to zero it out. So let's take a look at that one more time. So here's another example. We have a company. They have their total estimated overhead costs. They have their estimate for their direct labor. They have the estimate for their machine hours. And now we have their activity during the year. Let's take a look at what's their overhead rate, how much was applied, and are we under or over? So what is the predetermined overhead rate? Again, we're going to take the estimated total overhead cost divided by the estimated cost driver, which is machine hours. So we have $8 an hour. Now we're always going to apply based on actual machine hours. So we've applied 444,000, but are we under or over applied? Well, we have to figure out how much is sitting in that overhead account. So our actual overhead is 497,000. We take away our actual, and in this case, we are under applied by 53,000. That is never good news. Okay, so that's where we get that number. And that is the end of Chapter 2, Part 1. And next, we're going to go over in Part 2 for Chapter 2, we're going to go over the journal entries.